Our next guest says there's no way the Fed will pivot to rate cuts so quickly. Joining us now is Charles Schwab, Chief Investment Strategist, Lizanne Sonders. I don't talk to anyone that expects rate cuts, and yet the swaps market is pricing this in. So why is there such a big disconnect?
Well, the swaps market, you have to look at the range of positions that have been put on. And what's really happening is it suggests either the Fed pauses but then stays there for a while, or there's something more calamitous and they have to cut aggressively. You aggregate the data and it shows the possibility of rate cuts starting in mid-summer. So, understanding how that data is collected and then aggregated, I think, is important. And by the way, it's not impossible that the Fed would start cutting. It's just all else equal, meaning if inflation stays about where it is, even if it continues to trend down, but we don't see either something more calamitous in the financial system or we don't see significant deterioration in the labor market, then the Fed stays in pause mode. So it's certainly possible they could start cutting, but not under the current set of circumstances. That's really the point.
So is that a big risk then to the equity market here, given that when they don't cut, that's an effective tightening, right?
Well, no, it's going into pause mode. It just allows them to assess the impact of the monetary policy tightening that they've already done. It's the most aggressive cycle in 40 years. And even though the Fed concedes that so far they've been battling an inherently lagging indicator that is inflation, knowing the effects of changes to rates and the balance sheet are in the future, the pause is just that. It's a pause to assess. What I'm not sure I fully grasp at this point is how much of and it's not across the board strength in the market, obviously it's up the cap concentration, but whether a pause is sufficient to keep the market doing well, or is the market actually betting on rate cuts? And if it is it not paying attention to the conditions that would come into play to give the Fed a green light to cut? So I think that there's still some disconnects in the narrative out there. But I think it's for other reasons, not least being the debt ceiling. I think there are some clear risks right now. And I think that's one of the manifestations on a day like today.
Yeah. What are you telling your clients right now about the debt ceiling and how to be positioned around that?
Well, I wouldn't try to position around that. I think that's a fool's errand to try to trade around a situation like this, other than knowing that it's a potential volatility driver. It's clearly part of the uncertainty narrative right now. Everybody can remember or look back at what happened in 2011, where you came to the brink. We even then thought there was not a high risk of an actual default, but you got the S&P downgrade of U.S. debt, and you had a 18 or 19% drop in the equity market and a big spike in volatility. And I think the partisanship and brinkmanship maybe is on the worst end of the spectrum relative to 2011. I still think the best bet is an 11th hour, 59th minute deal. But I think it's coming into focus right now, and it's part of the reason for some of this recent weakness. But I wouldn't try to trade around it.